Hello everybody, welcome to another update on the stock screener. We are going to talk about Capstone Mining today because there has been major news. So let's take a look at the stock price first. It has bottomed out and is heading higher. So let's talk about the major news. So Capstone Mining has merged with Mantos Copper. And I think this acquisition is very good. So let's go over the presentation. We'll just talk about the most important things. So Mantos Copper has apparently two projects, the Manto Verde and Mantos Blancos. And one of those is next to the Santo Domingo project of Capstone. So this is going to bring synergies. So the Manto Verde is probably the one that's next to Santo Domingo. And that means I can use the same infrastructure. Very long mine life assets. And those assets are going to decline in costs. So that's something that I like to see. It can only get better in the future. So these are copper mines, some silver, iron, and cobalt. So cobalt is coming into play again. So just like Santo Domingo, we are acquiring a cobalt mine. Very interesting because this is probably the future. Cobalt is very important. Here you can see that the production will be going up a lot. So we are starting at this, going up, doubling, tripling. So there's huge growth coming here. And I will show you the numbers later on. Reserves almost doubled. So that's interesting. So this is the market cap and the reserves here almost doubled. Production also doubling. So here you can see that Santo Domingo is near the Manto Verde, sharing the same infrastructure, power, water pipeline, port. So I think there will be synergies and upside because of this in the future. And EBITDA will be around 1 billion to 1.5 billion. So that's a lot. This company has cash and debt facilities, so a lot of liquidity and good balance sheet. And so we just added two mines with a long mine reserve life. Here you see how the production will grow. So the production growth will be in 2024, so you need to wait 2 years. So if you're patient enough, you will see value getting added, probably in 2024, 2025. Okay, so for Mantos Copper, I would look at the production profile. This is the most important chart. So we start with production at an AISC of close to $3, which is high, but this is going to improve in 2024. And then the cost will decline below 2, and it will stay here. So that's a great prospect. It is already in production. It is making money at $3. So this is a good acquisition. And the other asset is this one. It's already in production. Pretty high cost, around 2.5, but declining in the coming years to $2. So actually not that bad. Okay, around $2 AISC. Okay, so let's do some calculations because that's the most important. So apparently Capstone Mining will own 60% of the combined company, and the market cap is around 3.3 billion right now. So that's this 3.3 billion. That's for the total company. And these are the projections of my valuations. And how do I come to this? So this is the production profile. We start with 380 million pounds or 175,000 tons. And that's today. Today we will have this amount. The AISC is around 2.5. We know that Capstone Mining has an AISC of around 2 right now, and Mantos is around 2.8, I think. If you look at this here, around 3, and then this around 2.7. So if you add this to Capstone Mining, I take 2.5. Okay. Then in 2024, we increase production to 573 million pounds, and I reduce the AISC a bit because this cost will go down to below 2. Okay, that's how I come to this number, and this is also around $2. Okay, so probably we will be at $2 AISC, and then when we have Santo Domingo in production, we go to 800 million pounds at an AIC even lower because Santo Domingo is very low cost, so it drags the AIC lower. So using these numbers, we come to this here. That's the fair value right now. Okay, so it uses the copper price of today, and it uses the AIC of 2.5 and the current production with a multiple of 5 to the EBITDA. So we are fair value right now, but in 2 years from now, we will be going to this scenario using the copper price and using the lower costs. So in 2 years from now, we will have lower costs, higher production. And that will translate into 3 billion going to 6 billion. So a double in 2 years. And then we go to this scenario, which is the Santo Domingo. So we add the Santo Domingo to the production using these numbers here, lower AISC, higher production with a multiple of 5, and that gives us this scenario. So we go from 3 billion to 10 billion. So that's threefold. And then we have some cobalt added to this. And if cobalt goes up, then the upside is even more. But there's some upside to that. So threefold, maybe fourfold. This is a buy. Okay, this is a buying opportunity. I don't have the of these numbers yet, but I think just looking at the earnings potential of the production increase in 2 years from now, this is a buy because those projects are already in construction. They're already financed. Okay. And let's do a sensitivity analysis. Goldman Sachs says that next year copper will be above $5. So let's say $5 copper. Then we go from 3 to at least 5. So that's a 50% increase this year until next year. And then in 2 years, we will go to 8.5. So that's almost a triple. And then with Santo Domingo, we go to with cobalt with it, then we have 14,000. So that's, what is it? Maybe a fourfold, 4 to 5-fold in 2 to 3 years. I think that's a very good return. And we all know that copper will go much higher, so probably reach 6 in a few years. And this can be a $20 billion company easily. So this is a buying opportunity. Will probably go up 5-fold in a few years. And I didn't even calculate the synergies between the two companies. So yeah, this is a keeper. And I'll see you in the next video.